Hello and welcome to the podcast BFI Talks, which is brought to you by Prague Finance Institute, affiliated with the leading Czech economics research center, Sergej EI. My name is Leoš Rousek. I'm the head of corporate communications at PPF Group, and it is my pleasure to welcome Barry Eichengreen, an economics and political science professor at University of California, Berkeley. Hello, Mr. Eichengreen.
Good to be with you.
As we've talked before starting this podcast, I've been reading, and I haven't really finished. I have to admit that. I make that disclaimer right away yet. Your latest book that you co-authored with other distinguished experts in the air on the era of fiscal deficits, public debts, and the book is called In Defense of Public Debt. So my first question is, do you think the current global monetary system is actually sustainable with more than 300 trillion or about that US dollar debt, which is equivalent to about almost 4% of global GDP?
Well, I'm not going to give away the surprise ending of the book. I'll let you get there on your own. I think at the moment it is important for the advanced economies to restore their ability to borrow. Debt levels clearly have gone up significantly. The silver lining is that interest payments on the debt have not gone up over the last 20 or 30 years because of the secular decline in interest rates. We now have the specter, the possibility of that secular decline in interest rates reversing, in which case the burden of servicing and retiring this inherited debt will grow heavier. The central point of the book is that the ability to borrow is a critical element in the arsenal of strong states when faced with a war, a pandemic, a financial crisis, and all hands on deck emergency. The ability to issue debt and mobilize additional financial resources is key. So that's what advanced countries did in response to the global financial crisis in 2008, 2009. They responded similarly to the COVID-19 pandemic and the economic fallout in 2020, 2021. But now that hopefully both finances and public health are beginning to normalize, retiring some of that debt by balancing budgets and growing the denominator of the debt to GDP ratio are key. So I think that point is clear. What is also clear is that it takes political consensus, political solidarity to do that. And I worry that polarization in many of our countries, starting with my own, the United States, makes reaching that consensus more difficult now than it has been in the past. So I do worry about the prospects going forward.
When it comes to the impact on monetary policy, I may actually go back into it a little more. I mean, there are clear benefits of the dollar, the US dollar, serving as a global currency from just a plain trading perspective and everything. But it is also, a store of value in terms of like US public debt. But given the recent initiatives, and especially in the wake of that tragic war in Ukraine, and, with a little bit of a move away from that, supremacy of dollar, or at least a discussion about it by some countries, including China, obviously Russia. But there are even talks by Saudi Arabia at some point, which I personally find very interesting because it's really hard to imagine them moving away from the petrodollars. I mean, how much do you think the rising debt and what you've just described, the sort of the arc of that development, could actually undermine the supremacy of US dollar as the global currency?
I do think there are internal contradictions in our dollar-based international monetary and financial system. Central banks and corporate treasurers need safe assets as kind of the bedrock of their portfolios, and US Treasury bonds have been the safe asset par excellence for more than half a century now. But the fact of the matter is that the United States cannot continue to provide safe and liquid assets to the rest of the world indefinitely into the future, all by itself. The logic of economic convergence is that emerging markets will continue to grow faster than mature economies, including the United States. Therefore, the US will, over time, account for a shrinking share of global trade and global GDP as emerging markets account for a rising share. That's why the US doesn't have the capacity. The US government cannot raise the revenues needed to service US Treasury bonds on a scale sufficient to provide safe and liquid assets to support 21st century globalization all by itself indefinitely into the future. Other sources, be they the Euro area or China or smaller economies, will have to step up, and their government bonds will have to supplement US Treasury bonds in providing that liquidity. That's a story about a more multipolar global monetary and financial system that I've been telling since I published an earlier book called Exorbitant Privilege way back in 2011. I argued this more multipolar system is coming. It has come more slowly, however, than I anticipated when I wrote that book going on 15 years ago. You pointed in your question to a second set of concerns, whether what is impolitely referred to as weaponization of the dollar and the US banking system by the US government, most prominently in the form of financial sanctions against the Bank of Russia and other Russian entities, will hasten the search for alternatives to the dollar and the US banking system. And SWIFT as international store of value and international means of payment. Will other countries contemplating even the remote possibility that they may end up on the outs with the US government now redouble their effort to seek out alternatives to the dollar and the US banking system as a form of insurance? Will they look to the Chinese renminbi and the Chinese banking system? Will they look elsewhere? And I think the logic of that argument is impeccable, but the alternatives are not particularly attractive at the moment. So countries contemplating the possibility of US sanctions sometime in the future are unlikely to look to Europe because Europe is on board with these G7 plus sanctions. China still has capital controls, and its cross-border clearing system, the cross-border interbank payments system that Chinese banks participate in, and which is renminbi based, clears only 2% by value the transactions that are cleared daily by the New York clearinghouse, CHIPS. So it has a long way to go before it constitutes a meaningful alternative to CHIPS, the US banking system, and the dollar.
Can we now switch to I'll simplify it a lot, what's good and bad borrowing? What will be your ranking in terms of what are the good related, what are the good and solid intentions for governments to actually go into debt, increase their debt gearing, and what aren't?
Well, I think we can approach that question from a number of different angles. Number one, governments shouldn't overborrow. They should maintain their fiscal capacity in good times, but it's a good idea to borrow to meet an emergency, as I described earlier. Wars, pandemics, financial crises that need to be managed, those all hands on deck emergencies. That's one angle that from which one can answer your question. Another angle would be it's better to borrow for productive investments than in order to finance government consumption, transfer payments, and so forth. Those productive investments in public infrastructure, health, education, that make for a more productive labor force, translate into economic growth, more government revenues, and the capacity to pay back what was borrowed. The distinction between productive investment and unproductive investment is easy to draw in theory, hard to draw in practice. Back in the 1980s and early 1990s, there was something called the Lawson Doctrine after Nigel Lawson, UK Chancellor of the Exchequer, that said borrowing for investment good, borrowing for consumption bad. But Chancellor Lawson failed to draw this distinction between borrowing for productive investment and borrowing for unproductive investment. It's hard to operationalize that distinction, but it's important to try. And a third and final angle from which I would answer your question is that some forms of borrowing, short-term borrowing and foreign currency denominated borrowing, are much riskier than borrowing long-term, issuing bonds long-term in your own currency. The problem being that most countries, virtually all low-income countries, lack the ability to borrow long-term, place bonds with foreign investors denominated in those countries' own currencies. So they end up issuing relatively short-term debt denominated in dollars, mainly. And when their currencies depreciate against the dollar, the cost of servicing that debt goes up enormously. Taxes are paid in local currency, and those countries get hammered.
When it comes to borrowing for tackling emergencies, and the COVID pandemic was an emergency, and there are lots of opinions that maybe that sort of various different packages of government assistance have been sort of overdone, that it has actually created this extreme flush of liquidity and really, after a few decades of relatively low inflation, actually really stoke inflationary pressures that we haven't really seen, well, in case of the US since the 70s, 80s, in case of the Czech Republic, which is still sort of on the verge of emerging / to sort of maturing market since the early 90s, but that was an impact of a economic transition. But anyway, to my question, do you think that in aggregate, all public spending and debt fueled public spending on the pandemic or during the pandemic has been productive?
Of course not. Politics intervene, and public interventions to support the financial system, or in the pandemic to support households who were locked down and temporarily lost their source of income, or in 2022, support for households suddenly facing massively higher energy bills. I think all of those were worthwhile examples of productive public spending and good reasons for borrowing, but the programs were poorly targeted. Politics got in the way. Everybody in the United States with a household income up to $150,000 got relief checks during the pandemic. I would have rather seen that relief scaled down a bit and targeted at the households most in need with a lower
Where would you put that? Where would you
threshold.
put that? In terms of like annual income per household, where would you put that sort of breakpoint?
I would put it a lot lower. So I at this point don't have a number that I would put on that. But similarly for energy relief, I'm not sure that every single household, regardless of their income and savings, deserve to receive energy relief check from the German government, for example. Again, targeting programs at those most in need would reduce the buildup of debt and relieve the inflationary pressures. Having said the latter, I would put a little different spin on the inflation than you did in your question. In the United States, the inflation that we've seen has mainly resulted from supply side disruptions due to the pandemic, and I think the energy shock as well. The Biden stimulus in 2021 was excessive, and I think was a subsidiary factor in the inflation that we've seen. But the overall fiscal response to the pandemic was not the major factor in this inflation problem that we've seen. Rather, it was supply chain disruptions and energy price shocks.
I have now two questions for you. So are you part of the transitory team or not?
I am among those who underestimated the magnitude and the persistence of the inflation problem. So I was part of the now discredited team transitory back in early 2021. But I do agree with those who now see strong evidence in the United States of core inflation falling fast and falling pretty close to the 2% target of the Federal Reserve. So if inflation is about to come back down, core inflation to 2% within a couple of quarters, was team transitory right or wrong?
It's really all about how you actually define the time span of transitory, and I'm absolutely in agreement with you when it comes to the two shocks underlying the real spike in inflation. Going back to the politics, because you are also professor of political science, what you just described, and it's been a global phenomenon that whatever energy related, pandemic related government aid in all countries, including the Czech Republic, has been just targeted at almost everyone. And it seems like just reading articles, talking to the people, that almost everyone understands that there are lots of people who actually were not in need of that assistance. And the question is, why do you think the politicians are not able to actually step up and say, we're doing it in a targeted way, and this is why ABC?
I think because building a political consensus is more difficult in our 21st century world than it has been at times in the past. I referred to political polarization before, and the difficulty of getting different groups to agree on targeted spending or to agree on measures of fiscal consolidation. So a few years back now in 2016, my colleague Ugo Panizza at the Graduate Institute in Geneva and I looked at a big sample, a panel of cases where countries were able to successfully bring down high debts. And political polarization is a problem in that context. Countries where the polity was less polarized were more likely to succeed. Why are our political systems more polarized now than they have been in the past? Is it social media? Is it the role of money in politics? That's an important question for my political science colleagues, a little bit above my political science pay grade.
So do you see inflation when it comes to like from the central bank's perspective, from the perspective of central banks targeting inflation, where do you see inflation going to those levels where the US Fed and all the other central banks, including the Czech National Bank, targeted, which is roughly around 2%?
It's hard to generalize, obviously, because different central banks have different mandates. They're trading off the 2% target against other goals that they may be mandated to achieve. Different central banks operate in different political systems, so they have different degrees of actual de facto independence to pursue their inflation targets. I think the Fed is strongly committed to bringing inflation back down to close to 2%. It would not be unhappy if it brought inflation only down to 3% rather than 2%, but neither would that be a disaster for the US economy. It might be a good thing from the point of view of those who argue a slightly higher inflation target would be healthier because that would provide more room for cutting interest rates.
Do you think that on the side of US Fed, do you think that this is really on the board of governors' minds, that they should maybe rethink their target?
I'm sure that they are ruminating on the question, but they understand that when there's a lot of chatter about inflation and a lot of worry about inflation and questions about their commitment, that is not the time to rethink. They have reiterated from Chair Jay Powell on down that they are committed to the 2% target. And I believe them in interpreting what they're saying broadly. And I think the European Central Bank is as well. The European Central Bank has a more difficult task because of very different debt levels in the different member states, and its commitment also to avoid fragmentation of the European financial markets, which means keeping Italian bond spreads from rising too high relative to German bond spreads. So the ECB is trying to kind of achieve three things with 1.5 instruments. It has interest rates, and it has this other targeted facility where it can adjust whose bonds it buys. But I think it's likely, both given that problem and given that Europe is facing a chronic energy shock that will persist for several winters, where the US is a net energy exporter, that too will make it harder for the ECB to get inflation down to target. I think it is committed to doing that, but it will take the ECB longer than it will take the Fed.
History never really tends to repeat itself literally, but everybody has been sort of pointing out to the 70s and 80s, various different waves of inflation, and it's been going up and down. Do you think that under current global economic and setup, and given all the information that's out there, how it's consumed, how it's distributed, do you think this is really a real concern, that there could be the sort of a repeat, almost like, like-to-like repeat of those different waves of inflation going up and down in the 70s and 80s?
If we have really entered a more volatile economic and geopolitical environment than the relatively moderate, placid environment we enjoyed in decades past, a more volatile geopolitical environment will make for more volatile economies and more volatile inflation. No question about it. At the same time, we understand monetary policy and how to manage inflation much better than we did in the 1970s. So Federal Reserve Chairman from Arthur Burns to G. William Miller in the 1970s basically thought that the central bank couldn't control inflation, that inflation was the product of what trade unions did and what firms with market power did, or what OPEC did, and they couldn't do anything about it. It took Paul Volcker to take over and communicate that the Fed, it was within the Fed's power to tame inflation, to bring that inflation rate back down after a very difficult 10 plus years. But we now have that knowledge, and Volcker's lesson has not been forgotten. So I think that's a reason to think that the 2020s will not exactly resemble the 1970s.
And what do you think, under the current circumstances, will it take for the US Fed to actually really contain inflation? Do they really have to stick to their guns and keep raising interest rates, by 50 basis points, or maybe slow it down as it has been sort of like indicated, or rather than indicated, mostly expected by various different market players?
I think the Fed is now able to slow down because core inflation has come down tremendously. When you strip out the cost of housing and energy and used cars, core inflation is already almost down to 2%. But for the Fed to succeed, the environment has to cooperate as well. So that means energy prices not going back up in the way they did following the outbreak of the war. What happens depends on Mr. Putin, and the Fed doesn't control Mr. Putin. It depends also on what the US Congress does, that we have to have a sensible fiscal policy that doesn't force the Fed to abandon its fight against inflation and buy treasury bonds big time, because the Congress has failed to raise the debt ceiling and havoc breaks out in the treasury bond market. So the Fed is only one element in the larger picture. And as I said before, it doesn't control the other elements.
I'm glad that you raised the debt ceiling question in the US. I mean, because it has been reached and broken and changed so many times. That number seems to be so arbitrary. Why does it actually even exist? I mean, and why should anyone actually take it even seriously?
Well, it exists because of World War I, which is a way of saying we should not take it seriously. Better would be to abolish the debt ceiling entirely, but it was put in place during World War I because the Congress was worried about delegating to the executive branch more power to spend on the military and other things. So it's a legacy of the past, which is best done away with. But it has symbolic value. And this Congress, it fights over symbols. So I do think that the danger of the debt ceiling being breached and the US government not being able to pay its bills is greater now than it was in 2013 or 2011, when there was a last-minute game of chicken played around the debt ceiling. This time, I think violation of the debt ceiling could extend for quite some time, unfortunately, and the government is going to have to decide who not to pay. And whatever it decides, it will excite financial markets in a bad way.
I have one last question, and sort of circling back to the monetary policy, and the question is about, do you think that gold could actually start playing a new role, or revitalized role in the whole monetary system? Could we even go back to some form of a global golden standard?
No, I don't, because I think inflation targeting is a much better combination of credibility and flexibility than a gold standard would be. A gold standard, if central banks and governments were really committed to it, would be credible, but it would lack flexibility. It would remove our ability to respond to recessions, financial crises, and other events. countries that are locked out of the actual existing financial system, like Russia, have shifted more of their foreign reserves into gold, away from US Treasury bonds and foreign financial assets more generally, because gold can be repatriated and vaulted at home, rendering it safe from sanctions. But it's really hard to use for payments. So there have been instances like that of Venezuela, which used some of its gold to pay for material from Iran to repair Venezuelan oil refineries. But Iran had to hire a bunch of jumbo jets and fly them to Venezuela in order to ship the gold back to Tehran. Such things can be done, but they're expensive, risky, and clunky.
That was a nice incident, or of trying to swap gold for the so-called black gold. Being the crude oil. Thank you, Professor. This has been very great and my pleasure to have a chance to talk to you. And thanks for being with us.
My pleasure as well. Fun conversation.